public markets were efficient before AI, how much more efficient can AI make them? Yes, information is going to be even faster. It's going to be even harder to blah, blah, blah. They're already really, really efficient. So I find it hard to believe that AI is going to change the pricing efficiency of markets materially.
Welcome, everybody, to the Building Better Portfolios podcast. I'm Josh, your co-host here with Paisley, and we have a special guest. We've got Steve McCourt here for episode 13. He's the co-CEO of Meketa Investment Groups. Meketa Investment Groups, this is data from end of 2014 or 2024, so I'm sure it's a little bit stale. 255 plus clients. They advise on over 2.3 trillion in assets. 240 plus employees, 160 plus investment professionals. A lot of their consultants, have 14, 15 plus years at the firm, and on average more than 25 years in the industry. So just a fantastic group. And Steve is just a fantastic individual. In fact, when I was going through a transition in my life related to work, I ran into Steve at a conference and got some amazing advice from him, and it's turned out to be fantastic. So I really do appreciate Steve as not just as a great, a pillar in the investment industry, but also as just a great human being. And so, Steve, thank you for joining us.
Great to be here, Josh, and thanks to you and Paisley for having me.
Okay, well, let's kick off the first question. So, Steve, why don't you fill us in or kind of tell us about your career?
Yeah, so I've had in some ways a very simple career, in some ways complex. So it started 31 years ago. Coming out of college, I was fortunate enough to complete or apply for a position that was being advertised in the Boston Globe classified section, as one did back then to get jobs. With Meketa Investment Group, which was a small 8-person organization in Boston. I had recently graduated the University of Vermont, where you can graduate with an economics degree and learn nothing about financial markets. And I didn't know what the investment consulting industry was all about. I had never heard of a defined benefit pension plan. And so the world was brand new to me. The industry was brand new to me when I joined Meketa. What I knew right away is I loved the people, I loved the company, and I loved the way that our industry combines sort of the technical skills of investing with the client service skills of being with people, and that sort of diversity in the job right away struck me as something that I really, really enjoyed. It's kind of both parts of the brain. And my career from 1994 through today has been entirely at Meketa Investment Group. However, I tell people I feel like I've had sort of 5 or 6 careers within that at the same organization, because we've grown so much over time. From as I said, 8 people in 1994 to roughly 260, 270 people today. So the organization has evolved tremendously. A big part of that was in the late 90s, Meketa being early adopters of private market solutions for our institutional client base. A big part of it was expanding geographically from Boston to other parts of the U.S. And a big part of it was expanding our client base from what traditionally was endowments and Taft-Hartley pension plans to many other types of clients across the country. And so it's been an incredible journey. I've loved every moment of it, and every different position I've had, over that 31 year period. and I'd say the three or four highlights for me, Josh, are in 1998, 1999, spearheading the development of Meketa's private market advisory services, which we might get into later. Sort of a lot of the reasons we went into private markets are starting to resemble sort of the reasons that private markets make a lot of sense in today's capital markets. Helping the company grow geographically by moving out to San Diego to open a West Coast office for us, and then helping open offices in other parts of the U.S. and London. And then 10 years ago, I became co-CEO of Meketa, and with my partner, Peter Woolley, have been managing the business on a day-to-day basis for the last decade, which has been another great challenge and fun experience. So it's been a wild ride. I've loved it, and looking forward to a lot more.
That's awesome. And Peter's also an amazing human being. And I feel like you would have to have two amazing people to be co-CEOs, because most times co-CEOs don't work out. And so I think it's fantastic that you guys have found a way to make that work. Do you mind just filling us in on something about yourself that most people don't know?
There's probably lots of things, but I think maybe most relevant for this crowd, I have an identical twin brother who's also in this industry. His name is Tavis McCourt. He works with Raymond James and is a market strategist for them, and for the last 20 years has been sort of a regular contributor to CNBC. For much of that time as a technology analyst with Morgan Keegan and Raymond James, and now as a market strategist. So at least 3 or 4 times a month, I get a call from a client or somebody who knows me in the industry that's wondering why I was talking on CNBC with the name Tavis under my picture that looks just like me. That's
pretty funny.
Yeah.
That's amazing. Yeah, they're like, hey, you should really call them and make sure they get your name fixed. And you're like, no, it's actually accurate. That's awesome. Well, let's dive into Meketa and fill us in on what a typical consulting relationship looks like. So if a large endowment, a pension fund is engaging you, what does that relationship look like?
Yeah. So one of the really neat things about the institutional consulting space, and I say advisory space more broadly, is every relationship really is different. And it means the role that our organization plays with different investment portfolios can change. I'd say core to that role, though, is the governance structure of institutions, whether they be endowments or public pension plans or private sector pension plans. Is at the end of it all, you have a board of trustees who are responsible for managing the plan and the assets of the plan. Boards of trustees under fiduciary law are able to delegate their authority to invest the assets to third parties, provided that they prudently monitor the authority that they've delegated. And so historically, our role was helping trustees delegate that authority by hiring asset managers in different asset classes, setting up an investment policy, and then finding the best managers in global equities and fixed income and private equity and so on. And then monitoring those strategies, reporting on investment results, and recommending changes to how they invest. So the consultant plays a role of effectively satisfying for the board their responsibility of monitoring any of the investment authority they've delegated to third party asset managers. As the industry has evolved, as I guess most things in life do, it's gotten more complex. So a lot of larger funds hire in-house investment staffs to manage as opposed to third-party managers. So in those situations, you're monitoring and overseeing investment strategies run by an in-house investment staff that's employed by the board of trustees. Many clients have gone to a structure where they hire specialist consultants. So we might be one of 3 or 4 consultants that are working with the pension fund or the endowment because they want one focused on private equity and one focused on real estate and one focused on broader things. And then you have a growing number of plans that are deciding that instead of delegating their investment authority to third-party asset class specific managers, they want to delegate investment authority to us and organizations like us to make the decision to invest in underlying asset class. So we become the outsourced asset manager for the plan. And that's the institutional OCIO marketplace. So that's the general governance structure. So it gets pretty complicated. It's very varied by client. I would say the core characteristics are, going back to why I love this career from the beginning. It is very much a client-centric, relationship-driven business. The board of trustees are your client. You have to know and understand the board. You have to communicate effectively with the board. You have to understand what their goals and objectives are. And in whatever governance structure they end up choosing, or you help them choose, you have to adapt your services and your investment strategy to meet their goals and objectives. So there's a lot of engagement with boards. Some meet as regularly as monthly, most quarterly. There's a lot of engagement, between meetings on different investment activities. We spend a lot of our time writing white papers on different investment topics to educate our clients. There's a lot of collaboration for larger funds that have in-house investment staffs. We have to collaborate with the investment staffs to help support them in their diligence of different asset classes and different strategies. So I boil it all down to, organizationally and individually, having the technical skills to assist these larger organizations in asset allocation and manager selection, and then the bandwidth and relationship skills to manage the relationship broadly.
It's complex, right? Because you can't just be a good investor. You also have to be a good educator. You have to be able to connect with the board. Like, there's so many different aspects to this, which probably makes it challenging, but also makes it a lot of fun.
Yeah, and I would imagine it's not that different from your industry. In our industry, performance matters, of course, but by far the biggest reason that consulting firms lose clients is you're losing trust in the client, and that's a communication and client relationship.
It's funny you mentioned that, because in several of our past episodes, whether we're talking about somebody who's investing in private assets, public, and they're in marketing role or investment role, the common thread that weaves many of these topics, and like you said, losing business or falling short of expectations, is the communication issue. So we should rebrand as like a communications podcast here. So I'm glad you mentioned that.
That's 100% been my experience over time. This industry at its core is a client service industry.
Yeah. I want to circle back to what you were talking about before in the introduction about private investments, and we've seen this massive democratization of private investments over the last decade, and I think there's still a lot more of it to come. And we're seeing, this push to have 401ks be able to allocate to private investments. What are your, what are your thoughts on that? Like, how do you think that's evolving? Do you think this is good? Do you think it's bad? And do you think that this is a way for individuals to start adopting some of these institutional investment processes into the way that they're investing?
Yeah, so there's a lot there. I'll start sort of at the broadest level. I think it's good, uh, and I think it's good for the broader economy, and I think it's good for individual investors. The um, the broader context I would bring to it, Josh, is from a public policy perspective. Our country, 40 years ago or so, shifted significantly towards encouraging 401k plans and discouraging defined benefit plans as the primary savings tool for individuals to save for retirement. And um, a topic for another podcast, a swing and miss from a public policy perspective from my vantage point. That being said, there are ways to improve the way 401k plans operate that make them better tools over time for retirement savings. Automatic enrollment and required matches and everything like that. But to me, access to private market solutions and 401k plans falls into that category. It makes retirement in the 401k plan industry a stronger savings tool for the country and for retirees. The retirees side is obviously adding more these asset classes that over time have proven value in sort of a mean variance diversified asset allocation mix is helpful. You're putting the individual on a level playing field with institutions, and that's helpful. But the other nice thing about private markets is because they are illiquid, the capital that goes into 401k plans in the future and into private markets is stickier capital for the economy. You're not investing in stocks that people can choose to panic and sell the next day, which is more often than not to their detriment, but it's also to the detriment of all those companies that use public markets for financing. So private markets as a savings tool for people is a more productive tool. It promotes true long-term, long horizon savings and investing in the economy, and I think that's in the aggregate good for everyone involved. My guess is, we're two pitches into a 9-inning game on this. The democratization of private markets into 401k plans is really just starting at this point, obviously, and it's really just starting, even filtering into just the wealth management space generally. So there's likely to be, over the next decade to 2 decades, a long-term shift in this direction that'll be married with, for the 401k world, hopefully regulatory clarity through different administrations, clarity from the courts on kind of what 401k plans are allowed to do in a kind of legal safe harbor way, and increasing amounts of product and services oriented towards investors and plan sponsors that have an interest in using private market solutions and 401k plans.
So maybe a question I have is thinking about the access to these markets that are illiquid. And from a retail investor perspective, there obviously is a gap in education. So I'm sure like Meketa is one instance that is looking to educate the broader industry on private markets, the risks, the opportunities. I would imagine that's a big part, though, of this kind of democratization of private markets into 401ks is like, how do we ensure that those, individuals are selecting, when they select these types of private markets, they actually understand the illiquidity and the risks, or just the different risk profile. And again, risk doesn't have to mean a bad thing. Risk can mean a positive thing too. But what are your thoughts on that education gap?
Yeah, I mean, it's large. I mean, we glimpse it, in the work that we do with the wealth management space today, and uh, it's certainly much larger in the 401k world. Um, so ultimately, I think what it means, Paisley, is that the decision, the end investor is going to be somewhat disintermediated. It's going to be somewhat intermediated from the decision to go into private markets. The very high likelihood is that as the Department of Labor clarifies rules and regulations around inclusion of private markets, the safe harbor guidance would be to include in target date funds. And so ultimately it becomes the target date fund manager who's making the decision to allocate certain amounts on your behalf into private market strategies. And it's their responsibility to manage the liquidity and manage the complexity. Mm-hmm. And then, of course, in a lot of 401k plans, if individuals have a sort of brokerage window where they can invest on their own for private markets, a lot of that's likely to be done through RIAs and fiduciaries, where there's, again, an intermediated decision to go into private markets. So I think that's likely going to be the way that investors are protected somewhat from the lack of knowledge that they have in private markets. Yeah. But at the same time, everyone's going to learn over time how these things operate, and I think the industry is stepping up to the challenge of education right now. We see a lot of it already in the industry, and that's just gonna grow. Yeah. But I would certainly say it's just drawing a parallel with the institutional world. When we started advising our clients to go into private equity in the late 1990s, very few of our clients knew what private equity was. It was a true bottom-up, education that we were providing into the asset class. But 25 years later, it's hard to think of a client or a prospect that I've spoken with in the last 5 years that isn't very aware of private equity and everything that's good and bad about it. It's everywhere. So the market will get educated, but these things take a long time.
And on that note, I mean, in my background, in my career, I've worked at large institutions and seen how large institutions invest. And there is a difference between how institutions invest and how many financial advisors and individual investors invest. And I think the all alternatives, right? Private equity, private credit, all those things are parts of that. How do you think, if you're a financial advisor, you're an individual investor right now, what steps can you take to start implementing the way that institutions invest money? What are some practical things that they could adopt?
Yeah. So for Meketa Investment Group, we a couple of years ago started a subsidiary, Meketa Capital, to kind of focus on exactly that in the wealth management space. And we developed two private market interval funds, the Meketa Capital Private Equity Fund, the Meketa Capital Infrastructure Fund. And we've been actively working with RIAs to integrate those into their platforms. As an individual investor and a wealth manager, I would say the decision to go into private markets can happen sort of at two levels. One, increasingly we're seeing RIAs and other financial advisory firms develop model portfolios for their advisors and clients that integrate private markets in a diversified way. And that seems to me like a very reasonable, prudent approach to integrating private markets across a broad platform of clients that you have. And then they also allow on their platforms, after a diligence process, top tier private market solutions that exist for the marketplace today, interval funds and other product types that are allowable for individual investors. And so if we're two pitches into the ball game for 401k plans, maybe we're kind of one or two batters into the ball game for kind of wealth management adopting private markets. And the pace of adoption seems to be really, really strong. The acceptance of the or understanding of the complexity of the private markets world, that private credit is different than private equity, which is different than private infrastructure, which is different than private real assets, is coming up to speed. And we certainly work with a few RIAs that are using privates today in a way not that dissimilar to how the largest institutions are using them. So I think the market is coming along quite quickly.
Maybe a question as a follow-up on that is, like, beyond private markets and thinking forward, oftentimes we think, institutional allocators tend to kind of pave the way, and then the high net worth kind of comes a couple of years later. So are we starting to see kind of some new green shoots of how institutional allocators are thinking about portfolio construction or asset allocation, like thematically from a sector or asset class perspective? Of course, private markets are front and center, but is there anything else that's kind of bubbling up that's interesting that you're starting to see?
Your listeners are going to think that I planted that question with you. I did not. So the big one is co-investments.
Okay.
So traditionally, institutions invested in private equity in particular, but other private asset classes as well, through fund vehicles, drawdown vehicles. And those drawdown vehicles charge 2% management fees and 20% carried interest. If you were the very largest allocators, allocating billions of dollars a year, you might get those fees down to 1.25% and 1.75%, but they're expensive. And about a decade ago, a lot of the larger public pension plans that have the resources began measuring more precisely the fees they were paying the private equity industry. And a lot of good work was done around that. And unsurprisingly, the results of all that are that the fund structure itself, over the life of the fund, extracts about 7 to 8% per year off the return of the assets inside the fund for fees for the general partner. So put another way, if your private equity programs returned 18% a year for the last 20 years, which isn't abnormal, that's what many of our clients have produced, the assets inside the fund had to return 25% per year. And the difference went to the manager. So co-investments have been around for a long time, but they've gained significant traction in the institutional world as a way to invest in those underlying companies in a fund without going through the fee structure of the fund itself. And general partners love receiving co-investment capital because it's for them, it's a relatively inexpensive way to finance acquisitions that they have to make in the marketplace, particularly in today's world where debt lending is more constrained. The average amount of equity you need at a private equity transaction is higher than it was 5 years ago. Co-investment capital has been sort of a growingly necessary part of the financing structure of private equity deals. And generally, when you invest with a general partner in a co-investment, you invest no fee, no carry. So some of our largest institutional clients today, are allocating a half or more of their entire private equity portfolios to co-investments, and it's a trend that everyone is trying to follow right now, because it's a very predictable way to reduce that fee drag on your portfolio. When Meketa Capital came to market with our private equity and infrastructure interval funds, we came to market with funds that solely have co-investments in them. That's all they have for private assets. So we focused our product offerings for the wealth management space on that particular part of the market, because that's where we see the institutional market trending over time for obvious reasons.
For those listeners who are less familiar with some of these topics we're talking about, can you walk us through what is a co-investment? Like, give us maybe an example.
Yeah. So let's pretend it's 1999 and KKR is buying a $1 billion company. In 1999, KKR would have had to come up with about $300 million in equity, and they would have borrowed $700 million from a bank. The $300 million in equity to buy the company, they may not have had sufficient capital in their fund vehicle for the full 300. So let's say they had $200 million in equity out of their fund vehicle. They had to go find the extra $100 million. And where they often went was their competitors. They went to Apollo or KKR and said, hey, we're lead investor in this deal. We need another $100 million to fill it. Do you want to be a minority investor alongside us in this deal? And their competitors would say, sure, give us access to all your diligence and trade secrets, give us a board seat, and pay us a point on the capital that we're going to provide. And that was the way deals were done in the private equity industry. Around that time, general partners, as they got larger commitments from larger limited partners, decided, hey, why are we going to our competitors for capital? I'd much rather have an LP finance part of this company if they're able to do it. So some very forward-thinking LPs, some larger ones in the industry, started dabbling with co-investments, and the general partner said, I'll give you these free because your free capital is cheaper than what my competitors ask of me when I need capital to fill the stack. So the co-investment industry was born there, and so instead of that $300 million of equity being filled with $200 million from the lead sponsor and $100 million from a competitor, that $100 million then came from a limited partner that provided the co-investment at no fee, no carry. And today, what's changed is, that billion-dollar company, might be worth $10 billion now with asset inflation, and the debt markets will no longer support 70%, debt in a deal. They'll support 50%. So that $300 million equity capital need from the sponsor is now a $5 billion capital need. So now you've got to get really creative with where to get that equity capital. You need more co-investment to do it. And so that's from the general partner's perspective, why they keep offering more and more co-investment. And from the limited partner's perspective, again, there's the enticement of being able to invest in these assets at no fee load is a really strong enticement. And I should also highlight the market really started growing after a sufficient number of research articles 5 to 10 years ago came out to sort of test whether or not there was adverse selection in the co-investments that were offered over time by general partners. And the majority of those studies showed that there was no meaningful adverse selection. It turns out general partners can't tell the future any better than we can. And so you're better off getting as many free deals from them as you can.
So adverse selection being, hey, they're just sharing the deals that they don't love as much, and they're not sharing the deals that they do love. But that's not the case.
That's right. If they really like to deal, why would they give it to you and not get carry on that deal? Well, it turns out the general partners really don't know which deals are going to pay carry or not. Nobody has a crystal ball.
Fantastic. Um, there's a quote that I've heard recently: AI will not replace humans, but those who use AI will replace those who don't. In the spirit of that quote, I mean, how are you guys thinking about AI in your consulting practice? But that also, I know you guys do due diligence on hundreds of managers a year, if not more. How are you seeing managers use AI in their investment processes?
Yeah, big topic. So um, I would. I'm going to start out by saying my experience in the wealth management world tells me that your industry is very optimistic on AI and very productive on its use. Um, I will say from our broader institutional clients, your audience should know there's a lot of suspicion and a lot of concern about AI as a technology and its impact on jobs, its impact on politics, its impact on the economy. Um, so, uh, all that to say, I think AI is going to be a really interesting journey, and it has the potential to um, dominate, not just economic discussions over the next decade, but political discussions, and um, it's going to create winners and losers. I guess is another way of saying it. From our perspective, the first I would say low hanging fruit that AI presents is just business efficiency. So where we've used it, and we started about 3 years ago developing internal policies around AI usage, responsible policies, and creating sort of internal teams that managed any adoption of AI solutions for different things that we do. Without giving away our trade secrets, I would say that the two areas where it's borderline revolutionary for us is one, first drafts of all the research that we do. AI has a lot of flaws, um, and you have to acknowledge those flaws. It makes a lot of mistakes, but the ability of AI to very quickly put together a C plus draft of research, which can then be elevated to an A plus, with human beings, saves a lot of time. And so that's one area. The other is sort of, I would say, the documentation and bureaucracy of what we all do. Meketa meets with 2,000 asset managers a year across every asset class, as a rough guess. Every single meeting, we log notes, we document those notes, we analyze the manager, we post our analysis. There's a lot of writing and a lot of thinking that goes along with that, and AI makes that whole process a lot more efficient. The transcribing video calls like this and coming up with meeting notes from it is, I'm sure most people are doing that these days, and that saves a tremendous amount of time. Again, it's all sort of like C plus work that AI does, but just getting the drafts of that saves a lot of time. The more challenging issue is to what extent is AI going to be used by asset managers and in the investment process at all. My cynical view, Josh and Paisley, is the public markets were efficient before AI. How much more efficient can AI make them? Yes, information is going to be even faster. It's going to be even harder to blah, blah, blah. but they're already really, really efficient. So I find it hard to believe that AI is going to change the pricing efficiency of markets materially. I think it'll directionally do that, but we're already 99.999% efficient in the public markets. In the private markets, I think there's a lot more room for AI to analyze data and information that's not publicly available. And so if you're a private equity general partner and you're buying a company, the amount of data that you can get, or the amount of data that a McKinsey or Bain can get that you hire to do the work for you, is amplified in an AI environment. And so I think I would look towards the private markets as areas where the information synthesizing power of AI is more likely to have a significant impact. And the final thing I would say, and this has been kind of interesting to us as well. So I think through like a lot of the asset allocation modeling that we do with our clients and CMA production and AI, it's an interesting straw man. So as an individual or an organization, it's often challenging to find ways to challenge your assumptions and to challenge your recommendations. AI makes that relatively easy. AI is good at scrutinizing things. It's good at, I would say it's not always good at finding answers, but it's good with inducing more questions to ask. And so running our asset allocation models and running recommendations through different AI tools allow us to kind of scrutinize what we do better, which I think is an interesting use of it as well.
Yeah,
that's a great point. Oh, go ahead, Paisley, and I'll add.
I was just going to say too, I wonder as this AI starts to trickle into the private market space, maybe increase transparency. And this is a topic for another day because we could unpack this for a while, but does the illiquidity premium or the premium earned from moving from publics to private start to get pressured lower if we now have access to all this information? So let's sit on that for maybe a couple months.
And the use of AI to be that straw man, I think, because it takes, I think it's sometimes, right, everybody has an ego. You ask a coworker, hey, can you take the other side of this argument? And you introduce some dynamics there that you can alleviate through the use of AI. So I think that's a very fascinating use case.
Yeah. Like as I think about it, AI may not be right, but it doesn't pick sides. It's objective in how it's wrong, and there's some value in just the objectivity of it, even if it's wrong.
Yeah. Well, thank you, Stephen, for all of your insights today. I'm just looking at the clock. I think we've run up on time, but really appreciate you taking time to sit down with Josh and I and kind of explain where Meketa's at, what they're seeing in the industry. This co-investing topic is something I had just initially started to hear about a couple of years ago, and as it's making its way through the institutional allocations and that becomes a bigger topic, maybe we'll have you back on or somebody on the team to dive deeper into co-investment. So appreciate your time and thanks for joining the podcast.
Happy to. Thanks to you both.
Yeah, thank you.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.